Hello class 11 Commerce. This class is another important class of business studies. In this class I am going to explain another important topic from insurance chapter, and today's topic is principles of insurance. Yes, principles of insurance. Now a very important long question may come in your exam, that is, state the principles of insurance. State the important principles of insurance, and this question can come for 6 marks. So today I will explain the important points of this question. So today our topic is principles of insurance. Principles of insurance. Principles of insurance, the most important topic of insurance chapter. So there are certain principles upon which this insurance is based. What are those principles? One by one I am going to explain. So talking about the very first important principle of insurance is principle of utmost good faith. First principle is principle of utmost good faith. Principle of utmost good faith. What does this mean? According to this principle, insurance is a contract based on faith. The insured, both the parties, the insured and the insurer, must disclose all the fact known to them. They must disclose all the fact to each other. They must not hide anything. The insurer must not hide anything regarding the policy, regarding the subject matter of the insurance. On the other hand, the insured is required to disclose the complete material facts, the complete details of the risk being proposed. So both the parties need to disclose each other every facts. The insurer and the insured must disclose every fact to each other. The insured must disclose the terms and conditions of the insurance policy, whereas the insured must disclose the everything related to the risk factor, everything related to the material facts. This is the first point. Second point is principle of insurable interest. Insurable interest. Now, what is insurable interest? What is this principle? According to this principle, the insured must have an insurable interest in the subject matter of insurance policy. Without this insurable interest, every contract is a void. Every contract has no value without this insurable interest. Without insurable interest, an insurance policy is a gamble and a fraudulent activity. So this is another important point of principles of insurance. Coming to the third point. The third point is principle of indemnity. Principle of indemnity. Principle of indemnity. Now, indemnity means compensation. According to this principle, the purpose of insurance is to bring back the insured in the same financial position as he was just before the loss occurred or before the loss suffered. The insurer must bring back the same financial position of the insured as he was before. So, the loss or the damage occurred to the insured must be bring back. The insured can get only the compensation for the actual loss that has occurred, actual happening that has occurred. He cannot make any profit out of it. For example, if the policy of the insured person is of rupees 2 lakh, but the damage that has occurred, that has happened, is of rupees 50,000. So the insured is liable to pay only rupees 50,000, not the whole policy value of rupees 2 lakh. Rupees 2 lakh he cannot get. He can get only the value of which the loss has occurred. The loss, if the loss have occurred of rupees 50,000, he is entitled to get 50,000 and not the full value, the full 2 lakh rupees, the full policy value he is not entitled to make. So thus he can make no profit out of it. He could be compensated only for the loss suffered by him. This is stated in principle of indemnity. Now comes principle of contribution. Number 4 is principle of contribution. Again, this principle is corollary to the principle of indemnity. According to this principle, if a person has taken more than one insurance policy, then and he has insurance policy with different insurers, then different insurers will pay him for the total loss occurred. He can be compensated for the total loss by different insurers. If he is carrying out different insurance policy with different insurers, he will be paid only for the loss that has happened by the different insurers. For example, I'll give you one example. If an insured has a damage of rupees 50,000. Now he had made two insurance policies with two insurers. The two insurers, insurer A and insurer B. Now insurer A will, if insurer A has compensated him 35,000 rupees and insurer B has, then insurer B has to compensate for the rest of the amount, that is 15,000. If the total damage is of 50,000, then the insurers who will pay for the damage will pay the proportionate amount. If one insurance company or one insurer has paid 35,000 rupees, then the rest of the 15,000, rest of the proportionate amount will be paid by another insurer, another insurance company. So one insured can carry on different policy with different insurers, but he will be compensated for the total loss by the different insurers, not much amount, not the amount more than that. Whatever loss he has suffered, he will be compensated for that loss only by the different policy, by the different insurance company. If he had more than one insurer, if he had made the policy with more than one company. So this is what is principle of contribution. Then we move on to the next principle, that is principle of subrogation. Principle of subrogation. Now earlier I have told you that the insured cannot make a profit out of the transaction. He will be compensated for the actual loss occurred to him. Now, doctrine of subrogation implies all insurance contract are contract of indemnity, which means the insurer acquires all the rights and remedies of the insured of the damaged property. The insurer will pay for all the damage, but if anything the insurer is getting after the damage, then the insured have no right over the property. I'll explain this again. Doctrine of subrogation state that once the insured is compensated, once the person who has suffered the loss is compensated, he don't have any right over the property which are being destroyed because of the loss. For example, if due to short circuit there is a fire in a factory and the total loss occurred due to that fire is rupees 1 lakh. Now this 1 lakh is being compensated to him by an insurance company. Now there are some half burnt goods in the factory or in that place, in that warehouse. If there are some half burnt goods, the insurer will try to sell those half burnt goods and make some money out of it. Now that total money belongs to the insurer and the insurance company. The one who has been compensated already, the one who has suffered the loss and being already compensated, have no right over the half-burned goods. Since he has already been compensated, he cannot make any profit out of the half-burned goods, out of the destroyed goods. He loses his right, he loses his ownership out of those goods. Now we come to the next principle, that is causa proxima. Causa proxima. Causa proxima. This means nearest cause. Suppose there is a causa proxima means nearest cause. This means suppose in a factory there is a fire, and due to that fire some goods are burnt. But during that process, during that burning process, some goods are stolen also during this process of fire. During this destructive process, some goods are stolen also. So here the insured will be compensated for the major or the nearest cause of destruction. That is, he will be compensated for the fire occurred, the loss due to fire, and not the loss due to the theft. Because the nearest cause is the fire, the destructive, the most major loss occurred or the major damage occurred is due to the fire and not due to the theft. So he will be compensated for the loss due to fire. Loss he has suffered due to fire and not for the petty loss due to theft. This is the causa proxima. And the last is mitigation of loss. Last principle is mitigation of loss. This is the last principle. According to this principle, the insured must take care of property or subject matter of insurance in the way as he would take care of it without doing the insurance policy. The insured should not become careless of the property. He cannot think, okay, insurance policy has been made, so I will not take care of my property. No, he has to take care of the property irrespective of the fact that he had made any insurance policy or not. He should take care of his property. Not that I have done the insurance policy, that means I will not be careful about my property. I will be totally careless about my property. No, he has to take care of the property fully, though insurance policy has been made. But he should be taking care of the property so that no loss has occurred. So this is what it is, the duty of the insured to make reasonable effort to save the insured property. Suppose if the goods are kept in the godown and have caught fire and the owner have the fire insurance, the owner should try to save the goods to minimize the loss or the damage. This is what the principle of mitigation of loss means. So these are the 7 principles of insurance, 7 important principles of insurance. This answer contains 6 marks. This question is very important and this will come in the examination. So prepare this question for the exam, and through a PDF I will provide the full answer of this question. In the next class I will come up with a different topic of insurance. Till then, goodbye.